Welcome to another deep dive, where we cut through the noise and get straight to the essential insights you need.
Good to be here.
Today, we're embarking on a fascinating exploration. It's the legal bedrock beneath nearly every business you encounter: company law.
That's right, foundational stuff.
Specifically, we're diving deep into Nepal's foundational legal document, the Company Act 2063.
A really significant piece of legislation.
Our mission today, well, it isn't to give you a dry legal lecture, no way.
Definitely not.
Instead, we're going to navigate the key regulations within this act, uncover some maybe surprising implications, and reveal the practical insights. Stuff that's crucial for anyone, really.
Yeah, whether you're just curious about the corporate world or maybe even a budding entrepreneur ready to launch.
Exactly. We're on a journey to extract the most potent nuggets of knowledge from this essential text.
And what's truly captivating about this act, it doesn't just dictate rules, it fundamentally shapes the entire ecosystem. Well, how businesses operate, how they raise capital, protect those who invest in them, shareholders, and ensure a degree of transparency in the market.
Right.
It prompts us to consider a bigger question. How do legal frameworks like this one influence and even, well, define the economic landscape of a nation? What does this particular act tell us about the aspirations and safeguards within the Nepali business environment?
That's precisely what we're here to uncover. Our source material for this deep dive comes directly from key excerpts of the actual Nepali Company Act 2063 itself.
Your real deal.
So get ready, because we're about to unpack some profoundly important legal provisions that govern companies from their very inception.
All the way to their eventual dissolution. It covers the whole life cycle.
Okay, let's begin at the very beginning. The core identity of this foundational document. The official name, as we've mentioned, is simply the Company Act 2063.
The year 2063 in the Nepali calendar.
Right, and for those wondering about the timeline, it officially came into force on Aayog 2063.
Which, for international context, that's roughly late 2006 in the Gregorian calendar.
Got it. And what's really interesting, I think, is that the Act itself proudly states it was enacted in the very first year of the declaration of the Interim Constitution, 2063.
Yeah, that's significant context.
It's not just a date. It places the Act firmly within a significant period of legal and political transition in Nepal.
Absolutely. It provides vital context for understanding how the modern business landscape began to take shape there.
So, right from the start, the Act sets up these definitions, and you mentioned they're crucial.
Absolutely crucial. They act as the bedrock for everything that follows. When this act talks about a company, it means a very specific legal entity.
Not just any business.
No, exactly. One that has been formally established and registered under the provisions of this very act. It's a legal person separate from its owners.
With its own rights and responsibilities.
Precisely. And the act then draws this fundamental line, meticulously differentiating between a private company and a public company.
Okay, what's the difference in simple terms?
A private company is, well, like it sounds established under this act, explicitly designated as private. Usually has a limited number of shareholders, restrictions on transferring shares.
Right, more tightly held.
Yeah. A public company, on the other hand, is broadly defined as any company that doesn't fit the definition of a private company.
So everything else, basically.
Pretty much. And this simple distinction, it holds immense weight. It dictates a company's structure, its capital raising abilities, its governance requirements, the whole level of public scrutiny it's under.
Okay. And beyond the company type, it defines ownership stakes too, shares and all that.
Yes, very precisely. A share is essentially a defined portion of the company's capital, right? A slice of ownership.
Makes sense.
Then you have preference share, which carries specific rights, often fixed dividends or priority if the company winds up.
Ah, preferential treatment.
You got it. Ordinary share is the more common type, representing residual ownership, typically carrying voting rights.
Standard shares.
But here's a particularly interesting one, bonus share.
Bonus share. Sounds good.
It is. But it's not just about issuing more shares. It's a method for companies to reward shareholders by capitalizing their existing profits, savings, or reserves.
So turning profits into more shares for owners?
Yes. Or sometimes, and this is often overlooked, bonus share also includes increasing the paid-up value of existing shares by drawing from those same internal funds.
Oh, interesting. So my share becomes worth more.
Kind of. It's like
Okay.
the company saying, we've got healthy reserves, and instead of cash, we're making your stake more valuable or giving you more shares without you paying extra.
Okay, that makes sense.
These precise definitions are absolutely vital. They dictate the financial DNA of a company: ownership structure, value distribution, capital flows. They're the foundation.
That level of specificity is fascinating. It really streamlines things legally, like how it defines court.
Exactly. Not just any court. It specifically refers to a commercial bench designated by the government of Nepal and only with the Supreme Court's consent.
So specialized judges.
Right. Ensures company law matters are handled by experts, making the system more efficient.
But then there's that definition of close relative. I mean, wow.
It's incredibly broad, isn't it?
It really is. It's not just immediate family. It's joint family members. Spouse, parents, in-laws, siblings, siblings-in-law, uncles, aunts, kids, grandkids, even granddaughter-in-law or son-in-law.
It covers a lot of ground.
It feels like everyone. Why so comprehensive?
Well, that incredibly detailed definition of close relative is actually a critical piece of corporate governance.
How so?
If we connect this to the bigger picture, such definitions are designed to proactively identify and hopefully prevent potential conflicts of interest.
Ah, okay, like in director appointments.
Exactly. Or transactions between the company and people connected to its management. Think about it. If a director's son-in-law gets a major company contract,
Without this definition, it might slip through.
precisely, it might fly under the radar. This level of detail isn't just arbitrary, it's a deliberate, necessary safeguard.
To ensure decisions benefit the company, not individuals through family ties.
Exactly. It brings transparency to relationships that might otherwise stay hidden.
Okay, so you've got your brilliant business idea, maybe a team. What's the first bureaucratic hurdle someone faces trying to start a company in Nepal under this act? What's involved in getting it legally off the ground?
That's a great practical question. The idea is exciting, but yeah, the groundwork is essential. The Act lays out very specific initial steps for company registration. It's basically building the company's legal identity.
So what documents do you need?
Key foundational documents. You need the proposed company's Memorandum of Association and its Articles of Association.
The Constitution and the roll book, basically.
You got it. Now, for a public company, if the founders made any agreements before incorporation, you need a copy of that.
Okay.
For a private company, it's a copy of any unanimous agreement among the founders.
Their initial understanding.
Right. And very practically, if your specific type of business needs pre-approvals or permits from other government bodies by law, like a bank or an airline.
You need proof of those first.
Exactly. You provide proof of those pre-approvals along with your company registration documents. It shows that starting a company isn't just saying you're starting one. It's laying down a formal, legally recognized foundation.
Makes sense. And just as important as knowing what to submit is knowing what might get you rejected, right? The act isn't just about letting companies form easily.
No, it's also about protecting the public and maintaining market order. That's a critical point for any entrepreneur.
So what are the main reasons the office might say no?
Well, the Act prioritizes protection against fraud and confusion. For instance, a proposed company's name or its core objective cannot be something that goes against existing law, public interest, morality, good conduct, or decency.
Common sense, really.
And it absolutely cannot imply any criminal intent. So, no illicit trading co. More subtly, but just as important for market integrity, the proposed company name cannot be identical to or confusingly similar to a company that's already registered.
Ah, preventing confusion.
Yes. And this also applies to companies that have been deregistered or gone into insolvency within the last 5 years.
So you can't just reuse a tainted name immediately.
Exactly.
Mm-hmm.
Imagine trying to open Starbucks Coffee Nepal. This rule stops that. It's a safeguard for consumers and established businesses. Keeps things clear.
Okay, now here's something fundamental. Shareholders. The number of them. You said it's a critical distinction between private and public.
It really is. It's at the core of a company's character and its potential for growth.
So what are the limits?
For a private company, the Act is quite strict. It cannot have more than 101 shareholders.
101. Why that number?
It's not arbitrary. It actively encourages a model that's typically tightly held, family-owned, maybe, or a venture among a small group. Businesses relying less on broad public investment.
Right, keeps it private.
Yeah. But there's a fascinating exception specifically for transport businesses.
Ew.
If they register within 3 months of a particular subsection's commencement, and operate through a transport business committee, they can actually exceed that 101 limit.
Interesting. Recognizing maybe a more communal structure.
Possibly, yeah.
Yeah.
Acknowledging the unique nature of some transport operations in Nepal.
And public companies.
Designed for much broader ownership. They must have a minimum of 7 shareholders.
Minimum 7.
But crucially, there's no upper limit.
Unlimited potential shareholders.
Exactly. And that open structure is what allows public companies to raise substantial capital from a wide investor base, shaping them into larger-scale enterprises with a different governance dynamic.
So the numbers really define the scope. But what if a public company, designed for many owners, starts shrinking? Fewer than 7 shareholders, say. Can it become private again?
Yes, it can, and it's an important safety mechanism. Ensures the legal status matches reality.
How does that work?
The Act provides a clear path. If a public company's shareholder count drops below 7, the minimum threshold.
It has to change.
Yes. Or if it fails to maintain its required paid-up capital, or its capital gets significantly reduced under other parts of the Act.
Okay.
In any of those scenarios, the public company is obligated to amend its memorandum and articles to formally convert to a private company within 6 months.
A forced conversion, almost.
It's a regulatory course correction. Ensures a company doesn't keep operating as a public entity with all the associated requirements if it no longer meets the fundamental criteria.
Maintains market integrity, makes sure companies are classified correctly.
Precisely. Based on their actual ownership and capital.
Okay, let's get into the blueprint itself. The Memorandum of Association, the Prabandha Patra, and the Articles of Association, the Niyamawali. You called them the Constitution and Bylaws.
That's a good analogy, yeah. These documents are the company's DNA.
So the memorandum first, what's in that?
The memorandum is the foundational one. A public statement of core identity. It has to clearly state the company's chosen name, the official address of its registered office, and crucially, its objectives, what it plans to do.
The big picture stuff.
Exactly. Broad declaration of purpose and existence.
And the articles, that's the detailed rule book.
That's where the operational details really come alive. Think of it as the company's instruction manual.
Like how meetings are run.
Yeah, general meeting procedures, number and terms of directors, provisions for alternate directors, independent directors for public companies.
Wow, really specific.
Oh, yeah. Rules for recording decisions, how the company seal is used, accounts and auditing procedures, how loans or debentures can be raised, even the steps for winding up the company. It brings order to everything.
And what if the articles say something that clashes with the main act?
Good question. The Act is clear. Any provision in the articles that conflicts with the Act itself or with the company's memorandum is legally void to that extent.
So there's a clear hierarchy. Act and memo first.
Absolutely. Ensures consistency, prevents internal contradictions.
That makes sense. So these documents are the bedrock. What if a company wants to change its core objectives, something listed in the memorandum? That sounds like a major change.
It absolutely is a big deal. Changing objectives can fundamentally alter the company's purpose, the whole basis on which shareholders invested.
So it's not easy.
No, the Act puts significant safeguards around it. If a company wants to change objectives, it actually needs a court order if certain shareholders object.
Which shareholders?
Specifically, a shareholder holding at least 10% of issued shares, or for private companies, 10% of the total shareholders, or for public companies, a minimum of 5 shareholders. If they feel the change is unfair to them, they can apply to the court.
And the court steps in.
Yes, but the court won't even hear the application unless it's satisfied the company itself has been properly informed of the objection.
Due process.
Right. And importantly, the amendment doesn't become legally effective until the court issues its final decision.
So shareholders have real power to challenge fundamental changes.
Absolutely. It highlights the legal safeguards for minority shareholders, preventing arbitrary changes that could undermine their investment or pivot the company away from its original purpose. A crucial check and balance.
Okay, moving from internal blueprints to the public side, especially when raising capital. Let's talk prospectus. That's the key document for investors, right?
Absolutely. It's the company's public invitation to invest, so accuracy and completeness are paramount.
What's the regulatory process for it?
When a prospectus is submitted, usually to the Securities Board, they scrutinize it carefully.
Looking for problems.
Yeah. If they find important details missing or irrelevant stuff included, they can demand amendments before giving approval.
Makes sense. And once the Securities Board approves?
Then there's a final step, The company must inform the company registrar's office, which will then formally register the prospectus.
A layered approval process.
Exactly. Ensures thoroughness and integrity in the information presented to potential investors. Crucial for market confidence.
And what about the personal responsibility tied to that document? If investors rely on it, who's accountable if it's wrong?
There's very significant personal accountability. Directors who sign a prospectus are held personally responsible for its contents.
Personally liable.
Yes. If it's later found that the prospectus was published with malicious or knowingly false information, and an investor suffers loss because they relied on it,
The directors who signed pay.
they are personally liable for the actual damages incurred by that investor. It's a powerful deterrent.
Wow. Are there any outs for the directors?
Yes, the Act provides clear exemptions. A director isn't liable if they'd already resigned before the decision to publish, or if they publicly announced the falsehood before the securities were sold,
Okay.
or if they can genuinely prove they had no knowledge the contents were false. So while the standard is high, there are paths for exemption if they acted responsibly.
But still, that personal liability really underscores the seriousness of public offerings.
Absolutely. And the immense trust placed in the information provided.
All right, let's get into the nuts and bolts of company finance under the Act. Shares and debentures. What are the basic rules about the value of shares, the face value?
Good place to start. For a private company, the face value is simply whatever its articles of association specify. There's flexibility there.
Okay, and public companies.
For public companies, the Act imposes a specific requirement. The face value must be at least 50 rupees per share,
50 rupees minimum.
or a higher amount that's cleanly divisible by 10. This standardization helps with market consistency.
Makes sense. And when a public company asks people to apply for shares, how much money can they ask for upfront? The application money.
The Act limits that too. They cannot demand more than 50% of the share's face value as application money.
So max 50% upfront. Why?
It's a measure to make shares more accessible, prevents companies from demanding too much capital right at the start.
Wider participation.
Exactly.
Right.
But there's a practical exception. Companies that have been operating for at least 3 years and have published audited financial statements for those 3 years are exempt from this 50% limit.
Acknowledging their track record.
Right. Their established credibility.
Okay, so that's about getting money in. What about when things go wrong? Like if the company owes refunds to applicants but doesn't have enough cash?
This is where investor protection really shows its teeth. If the amount collected for refunds is insufficient, the founders and directors are personally liable for the deficit.
Personally liable again.
Very direct accountability. Beyond that, if shares are distributed unfairly or with intent to cause loss to an investor, that can be challenged in court.
Investors can sue.
Yes. And if an officer knowingly violates these rules or allowed it, they are personally liable for damages and litigation costs.
So strong protections for fair allocation.
Absolutely. Ensures a level playing field and holds those in power accountable for fair practices. A significant safeguard. Now, companies often receive more than the face value for shares. That extra amount is the share premium, right? How can that money be used?
Correct. And the Act is quite specific about using the share premium account. It's treated almost like a special reserve, not general cash.
So not for everyday expenses.
No. It can be used for issuing fully paid bonus shares, capitalizing reserves, basically.
Okay.
It can cover any premium payable when redeeming preference shares. It can also write off preliminary formation expenses or expenses, commissions, or discounts incurred when the shares themselves were issued.
Specific capital-related uses.
Exactly. Maintains the integrity of the company's capital structure, prevents it just being spent arbitrarily.
And for public companies, the actual mechanics of issuing shares to the public, then they just do that themselves.
No, for public companies, the Act mandates a very clear professional approach. All activities related to issuing public securities, sale, distribution, collecting funds must be done only through a recognized securities dealer.
Need a middleman, basically. An official, recognized one, yes. Professional intermediation. And a copy of any agreement with that securities institution must be submitted to the office within 7 days.
Why so strict?
It ensures public share transactions are handled professionally, transparently, and follow market practices, vital for investor confidence and market integrity.
Okay. Let's talk about the proof of ownership.
Yeah.
Share certificates, and also debentures, the debt instruments. What are the rules for issuing certificates?
Share certificates are the formal proof. For public companies, the Act requires them to issue a physical certificate to each shareholder within 2 months of allotment.
2 months.
And their formal documents must be signed by 2 directors or the chief executive company secretary and bear the company seal if it has one.
And private companies.
Signing authorities are usually defined in their articles or unanimous agreements. It formalizes ownership legally.
Makes sense. And debentures, what's key there?
If debentures can be converted into shares later on.
A convertibility feature.
Right. That must be clearly stated in the prospectus. Investors need to know. The court can also enforce a contract to buy debentures from a public company.
Okay.
And critically, any company issuing debentures must have an agreement with a debenture trustee.
A trustee, what for?
They act as a guardian, protecting the interests of the debenture holders, making sure the company fulfills its obligations to its creditors.
Got it. And what about selling or mortgaging these shares and debentures? Can owners just trade them freely?
Generally, yes. They're considered movable property under the Act, so they can be sold or mortgaged like other assets. But
There's always a but.
always subject to the Act, the Memorandum, and the Articles. And there's a notable restriction on founders.
What's that?
A founder of any company, except a private one that hasn't taken loans from other companies, cannot sell or mortgage their shares until the company's first general meeting has happened, or until their shares are fully paid up.
Keeping founders committed initially.
Exactly. Ensures they have skin in the game before divesting. To formally register a mortgage on share or debentures, the lender applies to the company's office with the fee, the mortgage document, and the certificate.
And can the company refuse to register a transfer?
Yes, under certain conditions, like if the transfer document isn't properly executed or there's a court order preventing it, ensures orderly changes in ownership.
Beyond individual certificates, the Act emphasizes keeping accurate records, right? Registers.
Hugely important. They're the official source of truth for ownership and debt. Every company must maintain a dedicated shareholder register and a debenture holder register.
At their registered office.
Yes, in prescribed format. The debenture holder register, for instance, needs full name and address, number of debentures held, amounts paid and outstanding, registration removal dates, even nominee details.
Very detailed. And who gets to see these?
Critically, they aren't just for internal use. They are explicitly open for inspection by any shareholder or debenture holder who wants to see them.
Transparency again.
It's a cornerstone of good governance. Being able to inspect these records is fundamental for understanding who controls the company, who its creditors are, and ensuring proper governance. It empowers stakeholders.
Makes sense. Lastly, in this section, how does a company make sure it collects all the money owed for shares? Through share calls. And what if shareholders just don't pay?
Yes, share calls. And the Act gives companies teeth here. They can place a legal claim on registered shares.
Meaning?
They could even deduct dividends if a shareholder owes money for shares or other dues. When a company demands an installment payment, the call.
They send a notice.
Right, a written notice specifying the amount, deadline, place for payment, giving at least 30 days. For public companies, it's even stricter. The notice must also be published in a national daily newspaper twice.
Ensuring awareness.
Exactly. Now, if a shareholder still fails to pay within that period, their shares can be forfeited, according to the company's articles.
Forfeited. Gone.
Essentially, yes. The board of directors can then sell those forfeited shares to new investors.
So, real consequences for not paying up.
Absolutely. These provisions let the company collect its capital and ensure non-compliant shareholders don't hinder its financial stability. It enforces commitments.
Okay, so we've covered raising the initial capital, but companies evolve, right? They need to adjust their financial structure. What does the Act say about altering share capital? How flexible are they?
Exactly. Flexibility is key, but it's controlled. The Act allows companies to alter share capital, but it's a significant decision. It requires passing a special resolution in a general meeting.
High level of shareholder approval.
Right. And it must always align with the company's articles of association. The Act outlines several ways to do this.
Such as?
Well, they can increase authorized share capital by creating new shares that's typical for growth.
Makes sense.
They can consolidate or divide existing shares, combine smaller ones into bigger ones, or split bigger ones into smaller ones. Affects liquidity, maybe price perception. And they can cancel shares that haven't been taken up or shares that were forfeited for non-payment. This reduces the company's share capital by the value of those canceled shares.
So, tools to adjust strategically.
Exactly. For growth, market perception, or internal restructuring.
Increasing capital seems straightforward, but reducing share capital sounds more complicated. What about creditors? Are they protected?
Reducing capital is much more complex and strictly regulated, precisely because of the potential impact on creditors. It's not just a special resolution.
What else?
You must get court approval. This involves amending the memorandum and articles too. The court acts as a critical gatekeeper.
How does that work?
During the court hearing, anyone entitled to claim a debt or payment from the company must be allowed to present their claim or objection.
Creditors get a voice.
A very direct voice. The directors or company secretary have to submit a true and accurate list of all creditors, addresses, amounts owed directly to the court.
And the court decides.
The court can only approve the reduction if it's satisfied creditors' debts are paid, secured, or certain to be paid.
Strong protection.
Very strong. The court can even order the company to add and reduce to its name for a while and publish notices about the reduction, alerts the public.
Wow. And what if a creditor gets missed off the list by mistake?
Crucial point about liability. If a creditor's name was omitted due to the company's negligence and the company later can't pay that debt after the reduction.
The shareholders pay.
Yes, the shareholders become personally liable to pay that amount.
But not if it was the creditor's fault.
Right. If the omission was the creditor's own fault or negligence, shareholders aren't liable. But this whole process highlights incredibly strict protections for creditors. It's a significant check on corporate power, ensuring reducing capital doesn't hurt those owed money. Builds trust.
Okay. Besides issuing or reducing shares, companies sometimes buy back their own shares. Why do they do that, and what are the rules?
Share buybacks happen for various reasons: boosting earnings per share, signaling confidence, returning cash to shareholders. But the Act puts strict conditions on it to prevent abuse or financial instability.
Like what?
First, needs authorization by a special resolution in a general meeting. Broad shareholder approval.
Okay.
Second, after the buyback, the company's total debt can't exceed twice the ratio of its capital and general reserve. Keeps leverage in check.
Financial health check.
Exactly. And third, the amount used for the buyback can't exceed 20% of its total paid-up capital and general reserve.
Limits the scale.
Yes. And just to clarify, when the Act says debt amount for these buyback calculations,
What does it include?
it's comprehensive. All secured and unsecured loans taken by the company. Ensures financial prudence, prevents manipulation.
Got it. And once a buyback is done, what happens next? What are the follow-up steps?
Clear post-buyback requirements for transparency. The company must inform the office within 30 days.
What details?
Number of shares bought back, amount paid, other relevant specifics. Also, an amount equal to the nominal value of the bought-back shares must be transferred to a separate capital redemption reserve fund.
A special fund.
Yes, and it's treated just like paid-up capital protected, not for general use. Maintains financial solidity. Finally, the bought-back shares must be formally canceled within 120 days.
So they actually disappear.
Yes. These steps ensure accountability, maintain capital structure integrity, and prevent potential market manipulation.
Okay, we talked about registering a company, but for a public company, there's another step before it can actually start trading.
That's right. Registration isn't the final green light for a public company.
What is?
It cannot commence business operations without getting specific approval from the office to do so.
Approval to commence business.
Yes. To get it, the founders must apply and critically include proof that the full amount of shares they promised to buy at the start has actually been paid up.
Ensuring initial capital is really there.
Exactly. It's a regulatory gate.
Right.
Ensures financial readiness before they engage in commercial activity. There is an exception, though.
Which is?
A private company that's already operating and then converts to a public company doesn't need this separate commencement approval. It already has an operational history.
Makes sense. Already up and running. Right, let's talk about the core of shareholder democracy. General meetings. This is where shareholders get their say, influence the company. What about the annual general meeting, the AGM? When does that have to happen?
AGMs are absolutely central. Every company is mandated to hold its AGM within 6 months of the end of each financial year, a crucial annual check-in.
Within 6 months. And notice periods. How much warning do shareholders get?
The Act sets clear minimums. A public company must give at least 21 days notice for a general meeting.
21 days for
The
buy-in.
private company, it's a bit shorter, 14 days.
Yeah.
Gives shareholders adequate time to prepare.
Okay. What if a meeting gets adjourned and they reconvene? Same notice.
Interesting point. If an adjourned meeting is called and no new subjects are being discussed, a public company can give shorter notice, at least 7 days, specifically by publishing it in a national daily.
Quicker reconvening.
Yeah, acknowledges potential urgency. A private company, though, still sticks to its 14-day rule. These rules balance timely operations with ensuring shareholders are properly informed.
Makes sense. And within the meeting, what about decision-making? Can they just discuss anything that comes up?
No, the Act sets clear boundaries. Generally, decisions cannot be made on subjects that weren't notified in the meeting agenda beforehand.
No surprises.
Exactly. The only exception is if a significant majority, 67% of the voting shares, present personally or by proxy vote in favor of discussing an unnotified subject.
A very high bar.
It ensures major decisions aren't sprung on shareholders. The agenda sent with the notice also dictates the order notified subjects first, maintains focus.
And who can adjourn a meeting?
The person chairing the meeting has that authority, maybe lack of quorum or time runs out.
And what can be discussed in the adjourned meeting?
Any subject properly notified for the original meeting or for the adjourned meeting itself. Legally, the adjourned meeting holds the same authority as the original, and resolutions passed count as passed on that later date.
So it balances efficiency with due process.
That's the goal. Getting things done while ensuring shareholders are informed and can participate meaningfully.
Important point. Preventing people from pushing their own agendas. What about restricting voting rights, especially for conflicts of interest?
The Act is very clear here. A person is strictly prohibited from participating or voting as a shareholder personally or by proxy in discussions about terms or restrictions directly between themselves and the company.
Can't vote on your own deal.
Fundamentally, no. You can't vote where you have a direct personal stake conflicting with the company's interest. And it's even stricter for directors. A director, or their associate or proxy, cannot vote in discussions at a general meeting about their own actions, appointment, release, retention, pay, allowances, bonuses, or any contract where they have a direct personal interest.
Prevents self-dealing.
Absolutely. But outside these specific conflict scenarios, their general right to vote as a shareholder isn't restricted. These rules are essential for ensuring decisions are transparent and made solely in the company's best interest.
So those are the restrictions. But generally, what are the overarching voting rights? How do shareholders vote, especially if they can't be there?
The fundamental principle is clear. Unless the Act or article say otherwise, any person registered as a shareholder has the right to attend a general meeting and cast one vote for each share they hold.
One share, one vote.
That's the bedrock. Subject to those conflict of interest rules, of course. Now, practically, especially for big companies with shareholders everywhere.
Attendance can be tough.
Right, so the Act provides for proxy voting. Unless the articles prohibit it, any shareholder can appoint another person as their proxy to attend and vote for them.
So someone can vote on your behalf.
Yes. It's a crucial mechanism ensuring even dispersed shareholders can participate in governance without being physically present.
Okay. Beyond the votes, record keeping is vital. What about meeting minutes? What needs to be recorded?
Meticulous record keeping is mandated. Every company must keep detailed minutes of its general meeting proceedings in a separate book.
A formal record.
Very formal.
Yeah.
Must be signed by the meeting chairman and the company secretary, or if no secretary, by the chairman and one shareholder representative appointed by majority vote.
And what goes in the minutes?
Specifics. How the notice was issued, number of shareholders present, including directors via video conference, percentage of total shares represented, all decisions made, and if a vote occurred, the precise results.
Comprehensive. Can they do this electronically?
Yes. The Act allows minutes and reports to be disseminated via electronic communication, embraces modern tech.
And what about access to reports?
To ensure transparency, the auditor's report, annual financial statements, and director's report must be readily available to any shareholder who requests them. Detailed minutes and accessible reports are fundamental for accountability, and this transparency extends outwards too. Every company holding an AGM must submit copies of key documents to the office within 30 days.
Which document?
The number of shareholders and directors present, the annual financial statements, director's report, auditor's report, and a copy of all decisions made at the meeting.
Keeps the regulator informed.
Exactly.
That's
Ensures regulatory oversight and public access to key company info, fosters accountability and trust.
Now, besides the regular AGM, there are special general meetings. When do those happen, and what's a special resolution?
Directors can call a special GM if needed. But importantly, shareholders can too.
How?
If shareholders holding at least 10% of issued share capital, or 5% if multiple shareholders combine to reach 5% requested, the directors must call a special GM.
What if the directors refuse?
Shareholders can complain to the office. which can then step in and call the meeting itself. The office can also call one independently if an inspection reveals issues or for other reasons.
Gives shareholders leverage.
A crucial avenue, especially if the board is unresponsive. Now, a special resolution is a big deal.
Why?
It requires a higher approval threshold in a general meeting, usually 75% majority, reflecting the decision's gravity. The Act lists many instances needing one, altering share capital, reducing it, company buybacks.
Fundamental changes need stronger support.
Exactly. And finally, a practical but essential rule. Every report, statement, record, document submitted to the office under this Act must include the company's unique registration number.
For tracking.
Ensures proper identification, prevents mix-ups, essential for regulatory efficiency.
Okay, let's shift focus to the board of directors, the strategic brain, the guiding hand. What does the Act say about how many directors a company needs? Any specific representation required? Who runs the show?
The board is indeed where the big strategic and operational calls are made. The Act differentiates requirements for private and public companies.
How so?
For a private company, the appointment and number of directors are flexible, set by its articles, but there's an upper limit. Max 11 directors. Often suits smaller groups.
And public companies?
More formalized. Must have a board with a minimum of 3 and a maximum of 11 directors.
3 to 11.
And here's something noteworthy and progressive. If a public company has female shareholders, it must have at least one female director on its board.
Really? That's built into the law.
Yes. Ensures a baseline level of gender representation, acknowledgement of diversity in governance.
That's fascinating. Beyond numbers, director integrity and independence are key. What about disqualifications? Who cannot be a director?
The Act is meticulously detailed here, and for good reason, safeguarding against conflicts, ensuring integrity.
Billy's out.
An officer, auditor, or employee of the company, or even a former one if less than 3 years have passed, prevents revolving doors.
Makes sense.
Also disqualified, a close relative of an officer or an auditor or partner of the company's auditor, reinforcing that broad, close relative definition again.
Avoiding hidden ties.
Exactly. Beyond professional connections, there are character requirements. Unsound mind, criminal conviction involving moral turpitude, insolvency.
Basic fitness for the role.
Right. And for public companies, someone who's already a director of more than 5 other companies is out. Ensures they have enough time.
High standards. And what if someone becomes disqualified while serving?
They cannot remain in the position. It raises that important question about robust corporate governance. These rules are designed to prevent conflicts and ensure directors are independent, ethical, and fit for purpose.
So the Act sets a high bar. But what if, despite the rules, there was a flaw in someone's appointment that wasn't noticed? Are all their decisions invalid?
That's a crucial practical point. The Act provides a solution. Any act performed by a director remains legally valid even if a flaw in their appointment is discovered later. Yes, provided the act was performed before the flaw was discovered. Prevents constant operational disruption due to technicalities. Provides legal stability.
Sensible safeguard. Now, transparency again. Directors disclosing their own financial interests. What's required there?
This is a cornerstone. While serving as a director, if they acquire rights to shares or debentures not just of that company, but also its subsidiary, holding company, or any other subsidiary of the holding company.
The whole group.
Yes. They are legally obligated to inform the company. The disclosure is incredibly broad.
What does it cover?
Entering agreements to sell those shares debentures, transferring rights to purchase them provided by the company. Also, if subsidiaries or holding companies grant them rights, or if they transfer those rights, all must be disclosed.
No hidden interests.
Exactly. Ensures the company and shareholders know about directors' financial interests across the entire corporate group. Key for trust and accountability.
And what if a director or someone acting for the company goes beyond their authority and causes a loss? Can the company get that money back?
Absolutely. Clear mechanism for accountability. If a director or representative performs an act outside their authority and it causes financial loss to the company
can recover it from them.
Yes, directly from that director or representative. Strong deterrent against overstepping powers. Ensures personal accountability for harmful, unauthorized actions. And building on that, there's protection against fraudulent transactions, especially involving directors and third parties.
How does that work?
If a third party knowingly engages in a transaction with a director, or has reason to believe the director is doing it for personal gain or to harm the company.
The third party is also implicated.
Yes. That third party cannot make any legal claim against the company related to that transaction.
So if you knowingly help a director rip off the company, you can't enforce the deal.
Exactly. Protects the company from malicious dealings by holding both the director and the knowingly complicit third party accountable. Strong deterrent against collusion.
Okay. To keep track of who's actually on the board, what official records must companies keep?
Clear system needed. Every company must maintain a separate register for its directors and, if applicable, its company secretary.
What's in this register?
Detailed info. Full name, surname, address, nationality, profession, business, and the exact dates of appointment and removal.
Needs to be kept up to date.
Yes. Any change in this info must be notified to the office within 15 days. Provides a continuously updated, transparent record of leadership, essential for regulatory oversight and public confidence.
All right, let's shift to maybe one of the most critical areas, financial reporting and auditing. This is how everyone really understands a company's financial health. What about the annual financial statement, the AFS? What are the key requirements?
The AFS is the company's financial snapshot, crucial for transparency. For a public company, the board must prepare it at least 30 days before the AGM. Gives shareholders time to review.
30 days before AGM for public, private.
For private companies, the deadline is within 6 months of the end of the financial year.
And what must be in the AFS?
The Act is explicit. A balance sheet at year-end, a profit and loss account for the year, and a cash flow statement for the year.
The main statements.
Yes. And, critically, the AFS must present a true and fair view of the company's financial position, profit loss, and cash flow. That principle is fundamental. No misleading statements.
Got it. True and fair view. But beyond the numbers, there's the director's report. What's that for?
It's the narrative, providing context, management's perspective. A vital piece of the transparency puzzle.
What does it have to cover? It sounds quite extensive.
It is. The board's view on achievements, future plans, industrial relations, changes in the board and why, major factors affecting the business, the board's reaction to anything in the auditor's report, recommended dividends.
Okay, strategic and governance stuff.
Plus specific financial details. Details of forfeited shares number, value, amounts received. Details of directors and close relatives' personal interests in company contracts over the past year. Reasons for any share buybacks, including amounts.
Wow, very detailed disclosure.
And more. Details of internal control systems, total management expenses, lists of audit committee members, their pay, their work, any suggestions they made.
So it really gives a comprehensive picture.
It should. And the AFS and director's report must be kept open for inspection by any shareholder, signed by the chairman and at least one other director, underscoring accountability.
Right. Overseeing all this financial stuff is the auditor, the watchdog. How are they appointed?
The auditor's role is crucial for verification. Generally, the auditor is appointed by the AGM. Shareholders choose their watchdog.
Okay. What about the very first auditor?
That's slightly different. Appointed by the board before the first AGM, an appointed auditor serves until the next AGM.
And can the same auditor stay on forever, especially for public companies?
No, for public companies, there's an important safeguard for independence. The same auditor, their partner or former partner employee, cannot be appointed more than 3 consecutive times.
Term limits, basically. Forces rotation.
Exactly. Encourages fresh perspectives, prevents firms becoming too entrenched, though this doesn't apply to partners who genuinely separated 3 years prior or employees who left. Allows natural career moves. Rotation is key for audit quality. And this brings us right to auditor independence, which is just critical for reliable reporting. The Act lists extensive disqualifications to prevent conflicts.
Who's disqualified from being an auditor?
A director, officer, or employee of the company, a significant shareholder, 1% or more, or their close relative. Someone punished for an audit offense in the last 3 years. An insolvent person, someone convicted of corruption, fraud, moral turpitude in the last 5 years.
High ethical bar.
Very. And for public companies, it's even broader. Anyone working full or part-time for government, a government entity, or another company, or their partner employee. Or anyone authorized to sign management-prepared documents.
Really trying to eliminate any potential conflict.
Absolutely. Prevents even a hint of conflict compromising objectivity. And an auditor can be removed too. Same process as appointment, but needs prior notice to the Nepal Chartered Accountants Institute and the regulator. Grounds include acting against auditor conduct, against the company's interest, or against the law.
Okay. Beyond the external auditor, public companies often have an audit committee. What's that?
It's a crucial internal oversight body, mandated for public companies. Must have at least 3 directors, with at least two being independent.
Independent majority is key.
Yes, their functions are robust. They review the internal financial control system and risk management system, supervise internal audit activities.
So checking internal controls.
Exactly. They also play a role with the external auditor, recommending potential auditors, proposing their pay and terms for AGM approval, and they monitor if the auditor follows codes of conduct and standards. And this committee has real power. It's not just advisory.
Oh, so.
The Act lets them summon and question key personnel about finance. They can call the MD, CEO, other directors, the external auditor, internal auditor, chief accountant to their meetings for inquiries, and it's their duty to attend.
Serious oversight.
Underscores their role. The board must implement the audit committee's recommendations on accounts and financial arrangements. If they can't, the board has to state why in its report. Ensures the committee's insights have real weight, strengthening governance.
So we've covered internal controls, but what if there are suspicions of serious wrongdoing? How does the Act empower the office to act as a regulatory watchdog? Inspections, investigations, how does that work?
This is a critical function, a powerful check on corporate power. The office can appoint an inspector to investigate a company's business affairs.
What triggers an investigation?
It can be triggered by a complaint from a substantial block of shareholders, at least 10% of paid-up capital for a private company, or 5% for a public company. Give shareholders a way to raise alarms.
Okay. What if shareholders don't complain?
Importantly, the office doesn't need a complaint. It can initiate an inspection on its own if it reasonably believes the company's business involves cheating shareholders or creditors, illegal activities, gaining unfair advantages, or acting against the public interest.
Proactive power for the regulator.
Exactly. Even if shareholders are silent, the regulator can step in if broader harm is suspected, like a corporate police force stepping in when misconduct is indicated.
And if the investigation needs special skills, like complex finance stuff.
The Act allows for specialized help. If the investigation needs expertise the office doesn't have in-house, they can appoint a qualified expert.
A forensic accountant, maybe?
Could be. Or a specialized engineer, anyone with the necessary knowledge. Crucially, this expert must have no personal interest or prior involvement in the company's business. Ensures impartiality.
Makes sense. Ensures complex issues are properly understood for a fair investigation.
Absolutely. Leads to more robust findings and enforcement.
Now, investigations cost money, who pays, and are there personal consequences if wrongdoing is found? That could be a real deterrent.
That's where the financial teeth come in. Generally, the cost of an investigation started by the office is borne by the company itself, an initial disincentive.
Okay, the company pays first.
But here's the significant part. Personal liability. If the investigation definitively shows a director, MD, manager, or officer committed malice, fraud, or deceit.
They pay personally.
Yes, that individual is personally responsible for the entire cost of the investigation. They have to pay within 7 days of completion.
Wow, what if they don't pay?
The amount can be recovered as government dues, pursued with the full force of state collection.
That's a huge incentive to act ethically.
Very direct, very impactful. Consequences hit them personally, beyond the corporate veil.
Okay, companies don't last forever. Let's talk about voluntarily closing down. What happens when a company decides it's time to cease operations? What are the conditions for doing this voluntarily?
Voluntary deregistration is a structured process, mainly to protect stakeholders, especially creditors. A company can initiate it if it meets 3 key conditions.
What are they?
First, it must be fully capable of paying all its debts and liabilities. This isn't an escape route.
Must be solvent.
Right. Second, it can't be currently undergoing insolvency proceedings. It can't already be in financial distress requiring a different process.
Okay.
And third, the directors must submit a written declaration stating the company is solvent and can fully settle all debts within 1 year of passing the deregistration resolution.
Directors have to swear it's solvent.
Exactly. Ensures voluntary deregistration is for orderly winding down of solvent entities, not a loophole for troubled ones.
So if those conditions are met, what's the process? Who manages it?
The process centers around a liquidator. The company appoints a liquidator by special resolution. Interestingly, an auditor must also be appointed.
A liquidator and an auditor. What does the liquidator do?
Their role is critical. Immediately after starting, they take charge and control of all company assets, accounts, records, documents. Their job is to meticulously wind down affairs.
Can they get help?
Yes. They can retain or appoint necessary staff to assist. It's often complex. There's also a time limit.
How long do they have?
They must complete the process within the time frame specified at appointment. If they can't, for reasonable causes, the time frame can be extended using the same appointment process. And there's a crucial safety net built in.
What's that?
If, after starting work, the liquidator realizes the company is actually insolvent and can't pay its debts.
They stop the voluntary process.
Yes, they are legally obligated to halt voluntary deregistration and instead apply for a company insolvency review under the relevant laws. Prevents insolvent companies trying a misleading closure.
Makes sense. And once the work is done,
The liquidator submits a final report to the office, certified by the auditor, stating the company has been fully deregistered and affairs concluded.
and what's the very last step by the office?
The office plays the final role. Once it gets the liquidator's certified report, it issues a formal order to remove the company's name from the company register.
The legal death certificate.
Pretty much. After that, the office must publish a notice of the company's dissolution in a national daily newspaper. Ensures everyone is officially informed the company has ceased to exist legally.
So that's voluntary closure. But what about companies that are inactive, non-compliant, maybe just abandoned? Does the office have power to step in and deregister them, even if the company doesn't ask?
Yes, this is the regulatory authority stepping in. Ensures the register isn't full of dormant or non-compliant entities and prevents companies just disappearing without addressing obligations.
When can the office compel deregistration?
Several scenarios. If the founders apply, showing they couldn't start the business, and pay a fee. More forcefully, if the company fails to submit its annual report for 3 consecutive financial years.
3 years of silence is a big red flag.
Definitely. A clear sign of noncompliance or inactivity. Or, if it consistently fails to pay a fine it owes under the Act. These target dormant or consistently non-compliant companies.
What's the process for this compulsory deregistration? Do they just strike it off?
No, it's designed to be fair. Before deregistering, the office must issue a formal notice to the company. Gives it a chance to explain why it shouldn't be canceled.
An opportunity to respond.
Yes. If necessary, this notice is also published in a national daily newspaper for public awareness. If the company doesn't give a satisfactory reason within 2 months, or the reason is deemed unreasonable.
Then it gets deregistered.
Yes. The office then informs the directors and publishes a notice of this compulsory deregistration in a national daily parroter. And here's the absolutely crucial part. A huge protection for creditors.
What's that?
If a company is deregistered this way, any liabilities it had continue to remain in effect.
So deregistration doesn't wipe the slate clean.
Not at all. The officers or shareholders remain liable for fulfilling those liabilities. Just because the name's off the register doesn't mean debts disappear.
Wow. So you can still go after them.
Yes. It's a powerful deterrent against just abandoning a non-compliant or debt-ridden company. Ensures officers and shareholders can't just walk away from responsibilities by letting the company become defunct. Accountability persists.
Okay, let's talk about when things go really wrong and legal action is needed. Who can actually initiate lawsuits under this act? And on what grounds? How are disputes resolved?
The Act provides clear paths for legal action. Importantly, the office itself can file a complaint against a company, its directors, or officers in court.
The regulator can sue. When?
If the office finds the company's business is being run in a way detrimental to the rights or interests of shareholders, all of them, or a specific group, or if any act or omission by the company harms or is likely to harm shareholders.
So the office acts as a guardian of shareholder interests.
A vital role, yes. Stepping in when there's evidence of corporate misbehavior harming owners.
And can shareholders sue directly?
Yes, beyond the office, shareholders themselves are empowered. This is critical for internal accountability.
How does that work?
If the company itself fails to initiate necessary legal proceedings, maybe the directors are involved or unwilling.
Shareholders can step in.
Yes, any shareholder holding 2.5% or more of paid-up capital, or multiple shareholders who collectively hold 5% or more, can file a lawsuit on behalf of the company.
A derivative suit. Against who?
Against a director, officer, controlling person, anyone responsible for the wrongdoing. When they file, they must state what efforts they made to get the company to sue first, show they tried internal avenues.
That sounds like a powerful tool for minority shareholders.
It absolutely is. It raises that important question about shareholder activism and protection. Provide the vital way for minority shareholders to seek redress when leadership fails to act in the company's best interest. A tool against inaction or self-interest.
And for all these legal actions, where do they happen? What court? What procedure?
The Act clarifies judicial authority, Unless it says the office takes action, the court hears cases related to offenses under the Act, matters where the Act allows complaints or applications to court, and claims for damages.
So the regular court system handles it.
Yes, the designated commercial benches we mentioned earlier. And when hearing these cases, the court must adopt the procedure outlined in Nepal's Summary Procedure Act, 2028.
A specific, faster procedure.
Generally, yes. Standardizes the process, ensures efficiency and predictability for company-related legal matters, provides clarity for everyone involved.
Right, here's a really critical area. Related party transactions. This is all about avoiding conflicts of interest, those sweetheart deals, when a company deals with people or entities close to its management or owners. What are the disclosure rules here?
You're absolutely right. This section aims to prevent exactly that and maintain integrity. The Act imposes a clear, immediate disclosure requirement.
What needs to be disclosed?
If a company enters into a transaction with a related party, it must inform its shareholders and the office as soon as possible. The info disclosed has to be detailed. The date, the parties involved, a thorough description of the assets involved, including shares of other companies, if any, and their business, the exact transaction amount, and other key terms and conditions.
No hiding the details.
No. And this isn't just a one-off notification. It must also be comprehensively disclosed in the company's director's report, part of the annual review for shareholders.
Got it. Now, who exactly counts as a related party for these rules?
The Act casts a very wide net to capture potential conflicts. A related party transaction is between a company and its directors, their close relatives.
That's super broad definition again.
Yes. Also, its shareholders, officers, employees, or any of their related companies. It also explicitly includes transactions between a company and its subsidiary, its holding company, or any other subsidiary of its holding company.
Covers the whole corporate family and personal connections.
Exactly. This expansive definition ensures virtually all potential conflicts, direct or indirect, are brought into the light, fosters transparency, protects the company from exploitative dealings, and this is critical when dealing with corporate groups. The Act specifically addresses reporting for subsidiary companies in this context.
What needs reporting about subsidiaries?
The report must include the subsidiary's net profit after deducting losses for the year. A true picture. More specifically, it must account for profits and losses relevant to the holding company's shareholders that might not have been recorded in the holding company's own accounts since it became a subsidiary.
So a consolidated view of the group's health.
Precisely. Prevents opaque intergroup dealings obscuring the real financial picture for shareholders. And if the holding company's board genuinely can't get this info,
What then?
they have to include a written report stating that fact in the holding company's balance sheet. Transparency even when data is missing.
Okay, let's round out with some miscellaneous provisions. Maybe not neat categories, but still essential for modern operations and daily duties. First, technology. How does the Act handle electronic records?
It's actually quite forward-thinking. The Act explicitly allows decision books, registers, shareholder lists, accounts, other records to be kept electronically. Using computers, other means.
Embraces digital reality.
It does. Key requirements. Electronic records must be easily readable and reproducible. Accessible. They must also clearly show creation date and any amendments. An audit trail.
What if they're stored in some unreadable format?
The company has a clear obligation to provide an easily readable copy for inspection or submission when required. Balances digital efficiency with transparency and accessibility. It's also interesting how the Act touches on specific features for companies that aren't typical public or private ones, maybe nonprofits or member-based types mentioned elsewhere in the full Act.
How are they different?
For companies under these specific provisions, the number of directors is set by their articles, and crucially, directors are not required to hold shares to be on the board. A significant departure.
No shareholding requirement.
Right. And such a company can distribute shares directly to the private sector in a lump sum, not necessarily via the securities market. Suggests flexibility for unique organizational forms, tailored regulation.
Okay. A practical duty. Handing over documents when someone leaves. What does the Act say?
Addresses this directly for smooth transitions, preventing loss of records. Any director, officer, employee whose term ends must hand over all company papers and records in their possession to their successor within 30 days.
30 days handover.
Yes. And the successor is equally obligated to receive them. Straightforward, but critical for continuity, corporate memory, preventing disruption. The Act also clarifies rules around notices and distributing profits. For notices, if someone entitled to receive one states in writing, they don't need it.
They're considered notified.
Yes, streamlines communication. Also, if a shareholder attends a meeting, personally or by proxy, they're deemed to have waived their right to notice for that meeting. Practical. For dividend distribution, it's prudent. Dividends only from profits after deducting all past accumulated losses. Can't pay out money you don't truly have,
Pay debts first.
essentially. And if other laws require setting aside reserves first, companies must comply. Interim dividends can be paid from the previous year's profits if the board decides.
What about managing the dividend payout?
Approved dividend amounts must be put in a separate bank account within 45 days. Company must then publish a notice in a national daily at least a month before a deadline, inviting shareholders to collect.
Can the company use that money meanwhile?
No, it cannot be used for any other company purpose. After the deadline, if unclaimed, it must be deposited into a special fund, likely an unclaimed dividend fund. Ensures entitlements are handled correctly, funds managed responsibly.
Every company needs an official address. What are the rules for the registered office and the company secretary's role?
Fundamental operational stuff. Every company must register its office address with the office within 3 months of incorporation. Official contact point.
Need contact info too?
Yes, phone, fax, email. Must update the office immediately if anything changes. The office can publish a list of these addresses, enhancing transparency.
And the company secretary. Big job.
Pivotal administrative and compliance role. Responsible for implementing board and GM decisions, directives from the office, ensures all required reports and documents are submitted on time. Central figure in compliance.
Can they call meetings?
Yes, the company secretary can call board or general meetings. They also have to adhere to a prescribed code of conduct. Emphasizes their central role in governance and administration. Now, agreements between shareholders themselves, that can get complex. How does the Act treat those?
Private deals between owners.
Exactly. The Act says these agreements regarding management, operations, special rights are legally binding among them. Owners can customize beyond the standard articles.
But are there limits?
Yes, a crucial safeguard. Any provision in such an agreement that's detrimental to the company as a whole or its minority shareholders is automatically void to that
It
extent.
just protects against abuse.
Right. Balances private contractual freedom with protecting minority rights and company integrity. For transparency, 2 copies must be given to the company within 15 days, and the company sends one to the office within another 15 days.
Okay. What about a really unique case? A single shareholder company and the shareholder dies.
Practical succession scenario. If the sole shareholder dies, the Act provides continuity. Their heir, or whoever legally acquires the shares, steps into the shareholder's shoes.
Becomes the new sole shareholder.
Gains all rights, performs all duties. Decisions on share transfer or deregistration must be made in writing. Ensures clear legal succession. Prevents the company being left in limbo. Finally, the Act covers foreign companies operating in Nepal too. Ensures they're also under scrutiny.
How are they registered?
If an application is received, the office investigates and, if approved, registers the foreign company within 30 days, issuing a certificate. If not approved, they inform the applicant why within 30 days.
And deregistration.
The office can deregister a foreign company if it hasn't done business in Nepal for 3 consecutive years, or if the company applies, or fails to provide info. Before deregistering, notice published in a national daily twice, giving 120 days for claims.
What if claims arise, but assets aren't in Nepal?
Critically, the Act says those claims must be settled from assets outside Nepal. Ensures foreign entities are accountable, liabilities addressed even if assets are elsewhere.
We've covered so much, from formation to winding down, but what gives these rules teeth? Let's wrap up with the consequences. Penalties. What happens if companies or individuals don't follow the Act?
The penalties are the enforcement mechanisms, absolutely crucial. They ensure companies and officers adhere to the law. The Act prescribes various penalties for a wide range of offenses.
Like what kind of offenses?
Misappropriating or misusing company cash or assets. Using company money for personal gain without proper approval. Failing to settle advances owed to the company. Not complying with office orders. Failing to register company details or provide required info or reports.
Basic compliance failures.
Yes. The Act makes it clear there are tangible consequences for neglecting these duties, and it provides a detailed schedule of specific fines, clearly identifying who is liable. Reinforces individual accountability.
Can you give some examples?
Sure. Auditors failing to submit reports face penalties. Directors, managers, officers failing to comply with specific arrangements or violating rules on records or accounts. Companies or directors violating specific chapters or failing general duties. directors making false declarations about capital reduction, even people making false translations for foreign company documents. And for anything else, minor slip-ups, for any other act or omission not covered by the more severe penalties like failing to do something required, doing something forbidden, missing deadlines, acting improperly, not providing info or reports to the office.
What's the penalty then?
The court can impose a fine, ranging from 5,000 to 20,000 rupees, levied on the company or directly on the relevant officer or employee responsible.
So a catch-all penalty, too.
Exactly. This wide range of penalties, specific and general, raises that important question about enforcement. These penalties are the critical incentive for companies and leaders to follow the law, ensuring a fair, transparent, and orderly business environment. Hashtag outro.
Wow, we have covered an incredibly amount of ground today on our deep dive into the Company Act 2063.
We certainly have. It's a dense but vital piece of law.
We started by decoding the very essence of what a company is in Nepal, differentiating private and public, understanding terms like close relative. Then we navigated registration, the documents, the potential rejections.
Then the core blueprints, the memorandum and articles, amending objectives, the prospectus for public offerings, and that crucial director liability.
Our journey went deep into shares and debentures, face value, allocation, the share premium, how public companies issue securities, the certificates, debentures, transfer rules, and those meticulous registers.
Yeah, and then capital changes increasing, reducing, the court's role, creditor protection, and companies buying back their own shares. Plus, that key step of getting approval to actually commence business for public companies.
We unpacked shareholder democracy, general meetings, AGMs, notice periods, voting rules and restrictions, proxy voting, and the importance of minutes and records.
Followed by the board of directors numbers, the female director rule, disqualifications, duties like disclosing shareholdings, liability for overstepping authority, and keeping those director registers.
And then the vital financial reporting and auditing section, the AFS, the huge director's report, auditor appointments, term limits, disqualifications, and the power of the audit committee.
Can't forget oversight inspections, investigations triggered by shareholders or the office, expert involvement, and who bears the costs, including that personal liability for fraud.
We looked at winding down both voluntary deregistration with liquidators and auditors and compulsory deregistration by the Office for Non-Compliance with that critical continuing liability.
Then legal actions, who can sue and why, court procedures, related party transactions, and the intense disclosure needed.
And finally, all those miscellaneous but essential bits: electronic records, special company types, handover duties, dividend rules, registered offices, the company secretary role, shareholder agreements, handling a sole shareholder's death, foreign company rules, concluding with the penalties that enforce it all.
A comprehensive journey through the act.
Hopefully you found some genuinely surprising facts and maybe some illuminating insights that make this often dense world of company law a bit more transparent and maybe even, dare I say, interesting.
Well, if we connect all these pieces to the bigger picture, the Company Act isn't just a set of rules, is it? It's the backbone of economic activity. It shapes how businesses thrive, raise capital, and are held accountable.
A foundation for the market.
Exactly. And it reflects a comprehensive approach to governance and investor protection. This raises, I think, an important question for you, the listener, to ponder. How might a country's company law reflect its broader economic priorities, its cultural values, even its aspirations for business development? These legal frameworks are, in many ways, a mirror to a nation's economic philosophy.
That's a truly thought-provoking question to end on. Thank you for joining us on this deep dive into Nepal's Company Act 2063.
My pleasure.
We really encourage you to consider how these fundamental legal frameworks impact the companies you interact with every single day, from local shops to big corporations. Understanding these rules gives you a much richer perspective on the business world.
It really does.
Until next time, keep digging deeper.